Lately, I've been getting a lot of questions from you guys about what smart money really means. So here you go. If your broker decided to give you a grade on your trading tactics based on whether the trades you were making added any value to your portfolio, what kind of marks would you receive? It may seem like an outlandish concept, but one online brokerage did just that, and the results are somewhat surprising. The investors who were graded actually adjusted their trading strategies based on the feedback they received. Dumb money versus smart money. Now, average individual investors who trade money are often shoved under the dumb money umbrella. If you fall into this category, try not to take offense. The terms dumb money and smart money were coined by the financial media, not to insult anyone's intelligence, but to describe groups of investors. Big institutional investors and mutual fund companies are labeled smart money. These investors have somewhat of an unfair advantage over your run-of-the-mill individual investor. Armed with teams of experienced investment analysts, smart money investors can evaluate exactly what's going on in the market, allowing them to make more informed investment decisions. This does not necessarily mean they always make smart decisions. In fact, plenty of them make bad trades from time to time. They simply have access to valuable information that allows them to make a more educated choice. Now, on the other hand, the average investor generally does not have the time, the experience, or patience to analyze corporate reports or the global economy. Because these investors don't have access to teams of analysts or carefully compiled data, they often make trades based on instinct or a gut feeling. Okay, consequently, the dumb money group tends to buy and sell investments at the worst possible time. They buy stocks when prices are on the rise and sell those stocks when prices start to decline. For the average investor, the stocks they buy go on to underperform, and the stocks they sell go on to perform very well. Perhaps this is why the average investor typically earns 1 to 2% less than the average mutual fund. Now, if you've been following our videos for some time now, you'll notice that we are really big on 80-20. I'm always looking for the 80-20 in everything I do. From how I spend my time every day, how I run my multiple businesses, how I parent my children, and basically in every single decision that I make in my daily life. Now, you can apply 80-20, ignore most requests, and focus on a few big levers. You say no much more often, achieve more by doing less. 80-20 tells who and what you say no to. The difference between successful people and very successful people is that very successful people say no to almost everything. That's a quote by Warren Buffett. So always be looking for the levers in life. Once you know what those levers are, focus all your time and energy on them. Work them every single day. In 80-20, everything is about exponential growth, not linear growth, okay? Linear is just too slow. We always want the fastest way, and the fastest way is the 80-20 way, okay? So in smart money, it's all about making the tiny, small changes when trading, when investing to get the biggest, the highest possible rewards and returns from it. I'll share with you more on how we do it in our upcoming videos, so stay tuned.